Whether you're a first-time buyer, a seasoned business owner buying investment properties, if you're self-employed looking to get a mortgage, this video is for you if you live in Denver, Colorado. Today, we're going to dive into the different loan programs and the requirements and dispel some myths associated with getting a mortgage when you own your own business. Hey, Ray from Mortgage Maestro Group, and along the way, if you have questions and you're self-employed about getting a mortgage, drop them in the comments below and we'll get back to you. We're going to dive into 4 essential loan programs available to business owners, some of the requirements, and then some tips below if you're a business owner. But we're going to start with FHA first for those that need that loan program. If you're self-employed and looking to get an FHA mortgage, the reasons you might be looking to use FHA could be debt ratios, it could be your credit score. If your credit score is lower because of your business cash flow, which has impacted your personal finances, FHA may be the loan for you. But here's some important things you need to know about getting an FHA mortgage when you're self-employed pertaining to your tax returns. First, 2 years tax returns are gonna be required. Now, I'm gonna dispel a myth is that you have to have been self-employed for 2 years, because that is not true. If you were a plumber and you worked for a company as a W-2 employee and you have a full year of tax returns since becoming self-employed, you can likely qualify for an FHA loan being self-employed for that 1 year because you have a history in that line of work. Now bear in mind, if the tax return shows declining income from the year before, for those that have been self-employed for a long time, of say more than 20%, that may pose challenges for getting the FHA loan, but that's where your qualified lender comes into play for you to help you get pre-approved for this loan. Profit and loss statements, this is also going to be needed. They're essential to know if the income is stable. They're not going to qualify that income. If you filed taxes last year and it's later into the year now, and you're looking to get a mortgage, they're not going to use the income off the profit and loss. Rather, is the income in line with what was going on with the business last year? Is it increasing? Is it stable? Or is it declining? If it's declining, it doesn't mean you can't get a loan. It just might mean that further documentation, some explanations from you about what may have caused that. Did you invest in growing the business, etc.? So a qualified lender who may also be self-employed or have a vast depth and experience with self-employed borrowers who really will be helpful to you when you're getting an FHA loan and you are self-employed. If you're curious if FHA is right for you, drop questions below and we'll certainly get those answered for you here soon. Other things that will be needed: business licenses and verifications. They want to see that the business is active and open. That's really what you're looking for. If your jurisdiction doesn't require a business license, it's not going to be something you can provide. But a CPA can certainly write a letter showing that your business is open and operating if you don't have brick and mortar. Bear in mind, there are things that the lender adds back when qualifying you for an FHA loan and you're self-employed. One of those, as an example, is depreciation, depletion. These are other items outside of those that will be added back. So if you talk to a lender and they say, how much do you make? And you say $150,000 a year and I'm self-employed, and that lender pre-qualifies you off that verbal amount, turn and run, because you really need to send your tax returns to the qualified lender so they can pre-approve you appropriately when you go to buy the house. From there, I've also included some images as an example. Business mileage. Business mileage will be added back on a proportionate amount as allowed by the IRS for depreciable portion of your mileage. So I know I got into the weeds there, but there are things that are subtracted and added back to your income. That's why doing it verbally is not the smart play if you're looking to use FHA financing. Now let's transition to my veterans out there. As a vet myself, if you're self-employed and you're looking to get a mortgage, here are some things you need to know getting a mortgage and being a veteran when you're self-employed. Back to FHA, I mentioned the 2 years. It's going to be the same thing with VA. Similar to that, if you're an electrician or someone else who worked in the field as a W-2 employee and you have one full tax return, then you can be eligible to go off of 1 year self-employment when you have a history in that field as a W-2 employee. Profit and loss statements for VA. If it's been 6 months since the calendar turned, they will ask for a profit and loss. Again, this is not going to be added to your income, but it's going to be to determine the stability of your business and your cash flow. From there, they're going to look at the business stability to see that this is a good move for you as well. If you're curious if VA is the right loan for you and you're self-employed, drop a question or comment below. We'll get back to you with those answers. If the business shows declining income, again, that's more consideration. One benefit veterans have is that the VA really wants to help the veterans, but it has to be something that can be documented, such as you reinvested money into the business, so instead of profit, it looks like loss because of the expense. But that's where working with that lender to get those documentations, to get those letters of explanation really can be helpful for you when it may appear the income is declining, but you know it's actually not. There are add backs and subtractions. That's why, again, if you're getting a VA loan and you're self-employed, you do not want to do this with verbal math. You want to send the lender your financial documents. If they don't ask for them, I would probably turn and go the other way as a veteran myself. Let's move on. Conventional loans. If you're self-employed looking to get a conventional loan, the web is deep and wide on this one, everyone. The most important thing for you to know out of the gate is if you're self-employed between 1 and 2 years, this may work for a conventional loan. Again, considering different circumstances, this may be applicable. So bring this up when you're talking to the lender so that they can make sure you're qualified appropriately. If you own more than 25% of that business, I don't care what you call yourself, you're self-employed. Because if you weren't working or the company wasn't working, you would not have a W-2. But we can qualify the W-2 and the business income off the tax returns. So have this conversation with the lender. Again, make sure to send all your financials to them. As far as tax returns are going to be needed on a conventional loan, they are going to go for 2 years. But again, when you're self-employed, if you've owned it over 5 years, they may only ask for 1 year of tax returns. And we may be able to waive that requirement. So it does depend on the situation and the circumstances. So have deep and long conversations with your lender. If you're making the down payment from your own assets, this also can allow for lightening the load on those financials needed to get pre-approved when you're self-employed. And now if you're not sure if conventional is better for you or if FHA, if you're a veteran, drop those questions below and we'll get back to you with those answers. A profit and loss on a conventional loan is not always required, but again, the underwriter may ask for it depending on what they see in your overall credit profile. But again, this is deep and wide on conventional loans, so keeping it short and brief, just be prepared to have your financials organized. Now we're going to talk about non-traditional loans. This one is really abstract, so I'm not going to get into the rabbit hole on it, but know this. If you own a business, odds are you want to take advantage of the tax code. If you want to take advantage of the tax code, as your CPA will tell you to, you're going to minimize income to reduce tax liability, right? Like that's what any good business owner would do. That's what investment properties owners are going to do. That's what I would look to do as a business owner myself, take advantage of the tax code. If you've never read Tom Wheelwright's book, Tax-Free Wealth, I would highly recommend that book so that you're more aware. Don't just rely on your bookkeeper and your CPA. Be astute. I know your goal is to run that business and do it well, so you want to take advantage of the tax code. What does that mean for you? You might need flexibility when getting pre-approved to buy a home. So if your tax returns don't show the income and you don't qualify traditionally for that conventional, that FHA or that VA loan, what do? Well, there are lenders that will tell you, go claim the income, come back to me next year. But why would you do such a thing? The tax code is written for you as the business owner. We can qualify you off things like your bank statements, your 1099s, your profit and loss. Just be prepared that you're looking at a 10% entry point for down payment, though you can have some accommodations for your credit score. So if your credit score is lower, it doesn't mean you won't get the loan. It's just, is that the right loan for you? So be prepared on those types of loans because they will have a slightly higher interest rate and a slightly higher cost of borrowing. But here's where you have to think to yourself. Let's say it's $300 more per month for that loan than a traditional conventional loan. So $3,600 more in interest, okay? Would you rather pay the IRS whatever that's going to be so that your income qualifies traditionally by those bank lenders that are telling you claim your income, or have more of tax shelter, take advantage of the tax code, write off what you know and legally that you can, and have more mortgage interest deduction? That's what these loans are all about, is the deduction. and cash flow management. If I could put 10% down and I don't have to change how I file my taxes so that I can grow my business, it's more of a cash flow play than anything else. So keep that in mind when you're self-employed. On the bank statement option, we're probably looking at 12 to 24 months. From this, we're going to analyze profitability with an expense ratio, and that's how we're going to qualify you. It will give you more flexibility. Down payment, as I mentioned, 10% down, and I'm going to give you that example of the payment. As an example, a $750,000 house. What if I told you it was 2% higher in rate? And maybe that's $900 a month. I know I gave some examples earlier, but $900 a month, so $11,000 more per year. Would that save you $11,000 in taxes paid to the IRS? Or would you be better served paying that money to the IRS or not? I would say that the business owners I talk to would ultimately say that they've been better served by not claiming the income, making the 10% down, because really it's about cash flow and money management over qualifying for a traditional mortgage when you know these options exist. This is a real life example of someone who owned a roofing company, okay? We went to qualify him traditionally, and based on his tax returns, it would have come down to about $40,000 a year of qualifying income on a business that was generating 7 figures a year of revenue. So ultimately, the decision was made to go with a non-traditional loan. The qualifying income for him, $40,000 a month based on cash flow from the business, of the business financials and qualifying for that loan. They were able to buy their dream home. He was able to run his business from out of state, and they couldn't be happier. But again, you need to understand what you're giving up to what you're going to gain. And you got to think about the growth of the business versus protecting your cash flow versus the home that you know you can afford because you're told, quote unquote, you don't qualify for that. So when you're self-employed, keep this in mind because there are loans for you. Just prepare for a higher down payment, okay? If you're not sure if that type of loan is right for you, drop some comments below. Did you know that you can actually vest the title deed to the property in more flexible ways as well? And there's some debt ratio flexibility, up to 50% debt ratio on these self-employed loans as well. So this can be fantastic for you when you're a business owner. Let's wind down by talking about 5 tips for self-employed borrowers. Number 1, maintain good records. The faster you have access to that data, or you have the person you can sync up your lender to that will send it to them, the faster you'll get your answers and the smoother your closing will be. Whenever we've had people that have a great relationship with their CPA, their process is smooth and efficient. If they're not good at managing their books and their lender asks for a profit and loss and the business owner doesn't know what a profit and loss is, that's going to be a challenge. As a borrower who owns a business, it is time for you, if you don't already, to have a great CPA. If you need names of people, let me know. I can certainly refer you to some great CPAs. That is number 2, work with a CPA. If you're trying to grow a business and maybe that plan is to sell the business, what is your exit? If that's to sell the business, you need the right CPA to begin with, let alone how it will help you in qualifying to buy a home. Number 3, book your savings. Have your savings available. If you are self-employed, you likely can use money from your business bank account. However, ask that question to the lender, but make sure you have the increased savings because it will need for 2 things. Again, you need to show liquidity because how the underwriters approve the loans, they need to show that the business has an operating account. 2, for that down payment and post-closing savings and qualifying. From there, get a good mortgage broker. Wherever you're at in this world, find a good one. They're worth their weight in gold when you're self-employed because this could easily be garbage in and garbage out. If you're getting approved by a home, find the specialized lender when you're self-employed. Thanks for watching. If you have any questions, post them below. Make sure you check out another important video along your home buying journey here in Denver when you're self-employed. Talk to you soon.